Hello everybody and welcome to the session of financial accounting. My name is Marcus and we have prepared a line of materials for you to master one of the most difficult subjects being taught in your first semester. Feel free to pause, replay or slow down the video and don't forget to share it with your friends. This session we are going to cover the balance sheet. Well, what is the balance sheet? The balance sheet reflects the financial position of the company, and especially on what it does, what it has, and how it uses it. Balance sheets can be categorized in three different categories, which are assets, liabilities, and equity. Assets in a balance sheet, they are what the company owns and uses for its own financial gains. A few examples of this could be a company car, machinery, office buildings, and so on. Liabilities in the balance sheet, they are what the company owes either to themselves or other companies. This can mean a loan of a bank. This is a liability because we owe the money to the bank. But this could also be, let's say we pay our suppliers or we're a bit late with paying because we don't have too much cash on hand and they advance it for us. Eventually we have to pay them back that money. And that has to be written down as a liability, of course. Equity in the balance sheet represents the value of the company in the market. So that can be achieved either by issuing shares to shareholders, private equity purchases, or even financial performances of the year before, such as retained profit. So let's dive a bit deeper into the balance sheet. There are two types of assets, namely current and non-current assets. Non-current assets, they are assets you can have in your company and be used, but you don't or you can't liquidate them or get rid of them, and they usually have a lifetime of more than 12 months. Current assets, however, they are assets which are meant to be used or consumed or even liquidated in the financial year, so a period shorter than 12 months. A great example of current assets is inventory. Let's say I sell sneakers, the sneakers are my inventory and I expect to sell them soon. Then there are tangible and intangible assets. Intangible assets are basically all assets which do not have a physical substance. An example of this are patents, contracts, and even rights. Then, liabilities. Non-current liabilities are liabilities that last longer in your company for a longer period of time, just like non-current assets we just touched on. A great example of this is a long-term bank loan. Then, to finish, there is a rule in the world of accounting which is the most important of them all. Total assets must equal total financing. What does this mean? Well, it means that the total assets used by the company must equal to the total source of finances. So it tells us where the money goes and where it comes from and whether it's financed internally, externally. I hope this small introduction will help you in your studies and I'm sure we will meet again in one of our courses. Ciao!